Silver isn't running right now. Silver is testifying, and the testimony is uncomfortable. Because what it's saying is that the last few years were never a free market. They were a delayed reckoning, a system that kept stacking promise on top of promise until the day it bumped into something that doesn't care about promises at all. Physical supply. Here's the frame for everything you're about to hear. The biggest moves in silver since January are not random. They're not purely speculative. They are the predictable output of a machine that has run before, a machine that always ends the same way. First, trust gets built. Then credit expands faster than the real economy underneath it. Then pressure hits the system. Then value tries to escape into what cannot be diluted. And silver is where that escape gets violent. Not just because it's a monetary metal, but because it's also a critical industrial input that the modern world cannot function without. Stay with me to the end, and you'll be able to answer one question cleanly. Are we watching a normal rally, or are we watching the early stages of rationing? Because those are two completely different futures. They demand two completely different mindsets. And most people don't realize they're standing at that fork until it's already behind them. Let me give you three numbers, not for drama, for calibration. By the end of 2025, global debt climbed to a record $348 trillion, according to the Institute of International Finance. In U.S. fiscal year 2025, net interest on that debt came in around $970 billion, nearly triple what it was in 2020. And the silver market itself recorded a deficit of 148.9 million ounces in 2024, with industrial demand hitting a record 680.5 million ounces, according to the Silver Institute. Three numbers. One environment. A world drowning in obligations, paying an escalating price to service them, while consuming a strategic metal faster than it can be supplied. That is not a cycle. That is a structure. And here's the clean arithmetic of it. When the promise stack grows faster than production, there are only two ways the system reconciles the gap. It can default openly, or it can default quietly, through dilution and repricing. Most modern systems choose the quiet version because it buys time, and time is political oxygen. Now here's where silver becomes different from almost every other asset on Earth. It is simultaneously a monetary escape hatch and a production necessity. It can absorb fear and reality at the same time, which is why it doesn't move like a polite market. It moves like a pressure valve. So let's define the pattern, because the pattern is everything. Trust is built. People believe the measuring stick is stable. The system feels permanent. Then debt and promises grow faster than the real base can support. Liquidity starts impersonating prosperity. The measuring stick starts to bend. Then something reveals the overextension. Authorities intervene to preserve the structure. Intervention creates distortions. And finally, repricing. Value migrates toward what cannot be printed and cannot be delayed. Now I'm going to prove this pattern 3 times. And I want you to notice what's frightening each time. The triggers are completely different. The stages are exactly the same. Rome, early empire, the denarius carries real silver. It settles trade across a vast empire. It is trusted because it earns that trust, because it has substance. Then the obligations grow, military campaigns, infrastructure, the cost of dominance, and leadership faces the ancient dilemma: cut obligations and risk instability, or stretch the money and buy time. Rome buys time. This is where debasement enters the story. And I want you to understand it as a psychological weapon, not just an economic policy. Debasement says, we will keep the name of the coin, but quietly change the substance. The coin looks like continuity. The metal content tells the truth, and it always feels manageable at first, because it's gradual. People don't panic when the measuring stick bends slowly. They adapt, they complain, they keep going. Then confidence erodes, prices rise, trade becomes less fluid. People prefer tangible goods over distant promises. The state responds with controls and edicts, because that's what governments do when trust collapses. They try to replace trust with authority. But authority cannot restore a measuring stick once the public knows it can be changed. The system restructures. Money gets redefined. Taxes intensify. A trusted unit becomes a political unit. And once that happens, markets start pricing goods against reality instead of against the state's definition of value. Trust, expansion, crisis, repricing, first proof complete. America, 1971. The Bretton Woods system places the dollar at the center of global trade linked to gold. That link creates discipline, or at least the appearance of discipline. And in finance, appearance can last a very long time. Then overextension begins. Spending rises. Foreign holders accumulate dollar claims faster than the U.S. can credibly redeem at the promised rate. Not a moral failure, an arithmetic one. Too many claims, not enough anchor. Then a single sentence changes the world. The gold window closes. The system doesn't explode instantly. It doesn't need to. It simply becomes unanchored. And unanchored systems don't collapse immediately. They drift, then they shake, then they snap. The 1970s deliver the repricing phase: inflation psychology, energy shocks, volatility, metals surging. And here's the deeper lesson most people miss. Metals didn't surge because they were fashionable. They surged because they became a measurement again, when the old measurement lost credibility. If you think that era was about oil, you're only seeing the trigger. The mechanism was monetary credibility, breaking under overextension. Second proof complete. The setup is engineered stability. Risk is priced. Central banks are in control. Credit is endless. The system looks sophisticated, which makes people forget it's still built on trust. Then leverage stacks. Claims on the future multiply faster than real income and real production, disguised brilliantly: securities, derivatives, ratings, models. But underneath, it's the same machine, promises outpacing reality. Then 2008 hits and the system almost breaks. The response teaches the world a permanent lesson. The authorities will expand liquidity aggressively to preserve the structure. Zero rates, quantitative easing, backstops. The system survives, but the cost is philosophical. It proves that the unit of measurement is flexible when survival is at stake. Commodities and metals surge into 2011. Silver spikes dramatically, then collapses. Not because the structural lesson vanished, because paper leverage unwound violently and the system temporarily stabilized. But here's the question you need to sit with. If the system learned in 2008 that it can print to survive, what happens when the next crisis forces the same response, but this time the physical world is constrained by supply bottlenecks that printing cannot fix? That question is not academic anymore. That question is silver. Third proof complete. Now let's apply the same pattern to the present, like an audit. The post-2008 world normalized emergency policy. Markets were trained to believe intervention is default behavior. People stopped thinking in terms of sustainability and started thinking in terms of timing the pivot. That's not an insult. It's a learned survival strategy inside a system that repeatedly rescued risk. Setup complete. Then expansion and overextension. Global debt at roughly $348 trillion by end of 2025. A debt world isn't inherently doomed, but it is inherently sensitive. The larger the debt, the smaller the rate increase needed to break something. That's not opinion. That's physics in financial form. And U.S. net interest at $970 billion in a single fiscal year gives you the boundary of the cage. When interest costs scale like that, policy stops being preference and becomes constraint. The corridor narrows. The machine leans toward dilution because dilution is politically quieter than austerity. Overextension complete. Now crisis, and you can feel it. Fragmentation, supply chain insecurity, tariff regimes, geopolitical risk being repriced into everything. Silver posting sharp single-session swings. Don't get stuck on individual headlines. Headlines are sparks. The forest is the structure, a world shifting from smooth globalization toward strategic competition. That shift increases the value of reliability. And when reliability is repriced, inventory behavior changes. Hoarding rises. Thin markets snap. Stage 3 complete. And now the inevitable outcome, repricing into physical constraint. This is where silver becomes the main character. The Silver Institute's data shows a 148.9 million ounce deficit in 2024. Record industrial demand at 680.5 million ounces. That's not a bullish thesis. That's a procurement problem. And procurement problems don't resolve with sentiment shifts. Now here's the reveal that changes how you see all of it. This doesn't break in the chart first. It breaks in deliverability. The moment someone needs real metal, in the right form, on a deadline, and discovers that the available supply was a paper illusion. This is why silver behaves the way it does. Two markets stacked on top of each other. There's the paper layer: futures, derivatives, leverage, momentum. That layer can suppress signals, exaggerate signals, and whip price in ways that feel like chaos. Then there's the physical layer: bars, coins, industrial feedstock, refinery throughput, inventory, delivery schedules. That layer moves slower, but it is final. In calm periods, paper dominates. In stressed periods, physical demands a voice. And when physical speaks, it speaks through sudden repricing, widening spreads, premiums, delivery tension, and violent volatility. Consider what the data showed in early 2026, silver climbing to around $160 an ounce, then dropping sharply to around $84 within days. That's not a normal commodity tape. That's a market searching for equilibrium under pressure. And by late February, silver was surging again, roughly 5% in a single session, with analysts flagging the sharpness of moves as its own warning sign. So if you're wondering how silver can be structurally tight and still crash, here's your answer. Paper can unwind faster than physical can adjust. A paper flush doesn't create new ounces. It creates momentary relief. Then the physical layer pulls again. That's why these moves arrive as shocks, not gradual trends. A silver supply shock doesn't require mines to shut tomorrow. It only requires the deliverable float to tighten at the same moment industrial demand becomes inelastic. The shock isn't silver disappears. The shock is the silver that can be delivered at posted prices, on schedule, in required form, is smaller than the system assumed. Once that happens, price has to do two things simultaneously. It has to ration demand, and it has to signal supply. But supply doesn't respond instantly. New mining is slow. Much of silver is byproduct production tied to other metals' economics. Recycling responds, but it responds to price over time. Substitution isn't a button, it's redesign, requalification, manufacturing changes, multi-quarter cycles at minimum, so the repricing comes first, the adaptation comes later, and the gap between those two is where fortunes are made and destroyed. In normal markets, buyers are price takers. They wait, they bargain, they delay. In stressed strategic markets, buyers become availability seekers. They buy because stopping production is more expensive than paying up. And when availability seekers appear in a market, it stops acting like a casino and starts acting like an allocator. Allocation is just a polite word for rationing. Here's how rationing begins without anyone announcing it. Inventories thin at the margin. Lead times become uncertain. Buyers increase safety stock. Traders front-run tightness in paper. Volatility spikes. Margin calls flush paper positions. Price collapses briefly. Physical stays tight. Then the next catalyst triggers another spike. And the cycle repeats until demand collapses, supply surges, or price rises enough to force substitution. None of those outcomes are fast. None are easy. That's why the pattern feels inevitable, not because anyone is predicting the future, because the set of possible outcomes is constrained by arithmetic and physics. Now let's kill the three myths that keep people comfortable right until the pattern completes. The first myth: American exceptionalism means the dollar system can't face consequences. Debt math doesn't care about national mythology. When interest costs approach $1 trillion in a single year, policy becomes constrained regardless of which flag is on the building. The second myth: we'll grow out of it. Growth helps, but growth doesn't erase obligations when the promise stack has already expanded to planetary scale. $348 trillion in global debt is not a hill, it's the landscape. The third myth: technology will save us. Technology increases efficiency, yes, but it also increases metal intensity in grids, in electrification, in data infrastructure, in advanced manufacturing. Structural industrial demand is not a narrative. The market's own data points to record consumption levels, not declining ones. This time is different is the sentence people say when they want a moral exemption from math. Math does not grant exemptions. When promises expand faster than production, the system must reconcile. Quiet default through dilution and repricing is the path most systems choose. And when that reconciliation collides with a metal that is both monetary and industrial, you get the kind of moves silver has been printing. Now the practical framework, not financial advice, but a way of thinking that keeps you oriented when the market gets loud. Treat silver as a stress signal. When it moves violently, don't just ask what headline caused it. Ask what stress is leaking through the paper layer. That question keeps you from being captured by narratives. Separate paper price from physical conditions. In constrained markets, the most important variables are availability, premiums, and delivery behavior. Not just the spot quote. Spot can mislead for longer than you expect. Physical cannot. And if you choose to take any exposure here, respect the nature of this asset. Silver is famous for explosive upside and brutal drawdowns. That's not a flaw. That's what happens when a thin, dual-use metal is priced through leveraged paper while being pulled by structural demand. Risk management is not optional in a market like this. It's the entire game. Now let me close the loop I opened at the start. Rally or rationing. The biggest moves since January look like a market rehearsing for a world where delivery matters more than quotes. When that shift spreads, when more participants stop trading the story and start demanding the metal, the market doesn't drift higher politely. It resets. And resets don't announce themselves. They arrive as gaps. They arrive as candles that look impossible until they don't. They arrive as days where the chart seems broken because the system is correcting an assumption that was quietly wrong for a very long time. So here's what to watch for. 3 signs that we're moving from rally into rationing, repeated spikes that don't fully retrace, even after frightening sell-offs. That suggests underlying urgency, not just momentum chasing. Dips getting bought faster and faster, not because traders want profit, but because someone needs inventory. And the conversation shifting from price targets to where do I source it and how long will it take? That is the language of constraint. And once that language enters mainstream conversation in a commodity market, the dynamic has already changed. When those three signs cluster, you're no longer watching a trade. You're watching a system change states. The next step, the part most channels avoid because it forces uncomfortable questions, is mapping how the machine was actually built, not with conspiracy, with mechanics, how the promise stack grew, how paper silver absorbs stress until it can't, and what happens when the physical layer stops cooperating. Because when that moment arrives, you won't get a warning headline, you'll get a gap.